Kia ora koutou. Welcome to today's panel discussion that's brought to you by Sharesies. So Sharesies is a wealth development platform where our purpose is to create financial empowerment for everyone. Today we'll be talking about what's been happening in the share markets recently and what that means for you as an investor. So I'm Sonya, I'm one of the co-founders of Sharesies, and today we'll be joined by two excellent panel guests, which I'll introduce shortly. Before we start, I'll just start with a small legal disclaimer that investing involves risks. You aren't guaranteed to make money and you may lose the money you started with. Any information we provide is general only and current at the time. If you're looking for help with your investment choices, we recommend talking to a licensed financial advice provider. So today, we will be talking about what's going on in the markets, and we'll have our guests here who will be sharing. But nothing that we'll be talking about will be personalized advice as part of this webinar. But do ask any questions that you have in the Ask a Question box. It's a really good time to any burning questions. There's no such thing as dumb question. Put it in the box, and we'll make sure that we do our best to get around to it while we've got our experts here. If you leave questions in the chat, we may not get round to them. So please do put it in the Ask a Question box. And then finally, please be kind and respectful towards our guests and your fellow viewers. Otherwise, we'll need to remove you from the webinar. So as I mentioned, it's been a bit of a shaky start to the year in markets. And I think a few of you, we do have a lot of people joining us on the webinar today. And people may have been noticing this in your portfolios. So stoked to be able to introduce our guests. First up, we have business journalist Rod Oram. So Rod's been working as a journalist for 40 years, and not just in New Zealand. He's worked for international media organisations like the Financial Times, and he should be joining us now. Kia ora, Rod.
Oh, kia ora, Sonya. It's a great pleasure to be with you all. Thank you.
Thank you. And so our second panelist is Greg Smith, and he's the head of retail at Devon Funds. Prior to that, he's been the head of research at the Australian Fund Management and Market Research business Fat Profits, which is spelt profits, P-R-O-P-H-E-T-S, by the way. But he's also worked in London as an operations manager for Mellon Global Investments. So welcome, Greg.
Hi there, kia ora, and great to be here.
Thanks. So let's start with a bit of an overview. Obviously we've had the Fed decision today, the Federal Reserve, which we will get to in the chat, but thought it's best to just start with a bit of an overview of what's been happening in the share market. So what we've seen is the S&P 500, which is the index tracking 500 of the largest companies listed on the US stock exchange. And it's often used as a bit of a benchmark for the state of the share market. Since the start of the year, it's declined to around 8%. We've also seen the NZX 50 in New Zealand and the ASX 200 in Australia decline by similar amounts over the same time. So we'll start with you, Greg. What are some of the major factors that are contributing to the dip?
Well, obviously COVID's still with us, so obviously that's very relevant. And Omicron obviously came along towards the end of last year, although that actually didn't stop the markets having a bit of a flourish at the end of 2021. The NZX was looking at being down 3, 4, 5%. It finished the year roughly flat. US indices, they had a much better performance last year, as did the ASX 200 across the Tasman, up over 10%. But yeah, this year, we're getting, I suppose, dragged down with the other indices. So, what's going on? I think really it's about those two big eyes everyone will probably be reading about and experiencing as well. It's inflation and it's interest rates, and that's relevant to people that borrow money or invest money, but it's also very relevant to stock markets. And I think what you've seen is, I suppose, that really being front and center. While the RBNZ last year raised rates, one of the first central banks to do so, a lot of other central banks are only really just getting started, and obviously the Fed meeting we're going to talk about. So I think that's what's causing a bit of angst. You've had markets had a real extended run, and valuations have been getting a little bit overheated. Interest rates are sort of used to assess valuation, so very relevant to sort of growth stocks. So you've seen them come off and be very volatile, obviously, this week as well. So I think, that's the key driver as things stand. Inflation, and, we know it's been running hot for various reasons, supply chain. But the question is it here to stay, or is it maybe going to go away as the world opens up? And central banks have gone from saying it's going to be transitory to it's actually going to stick around a bit, and we do need to act. So I think that's what's causing a bit of a reaction as we enter the year. So it's gotten off to obviously a very volatile start.
Can we dig into the inflation part of it a bit more? Because you did mention the two eyes there. What is it, and how does it affect interest rates and what's going on in the market?
Well, inflation is basically prices. So prices going up is inflation, prices going down is deflation. And we've had low inflation for a long time. If you look at the world economies and what's happened during the pandemic, obviously a lot of stimulus has been pumped in, interest rates have been reduced. You've had quantitative easing, you've had governments printing money in some cases and spending money, and this is, I suppose, to literally reinflate economies. But then obviously it can go the other way, and the inflation genie, as you often hear talk about, can get a little bit out of control. And a little bit of mild inflation is good. It's actually can be quite positive for stock markets and economies, but you don't want it going too far the other way, and that's sort of, I suppose, having a negative effect on economies. So that's sort of, and central banks are basically there to help keep that in check. We've got inflation numbers actually out in New Zealand as well today, but yeah, inflation all around the world is rising, and you can't just sort of let that go unfeathered, if you like, and that's why we're seeing a reaction there. But inflation can erode the value of assets effectively as well. Also erode the value of debt as well.
Yeah, thanks. And how about you, Rod? What are you observing?
I'm very much focused on all those same trends that Greg is, and I'm still very much undecided about where things might track from here, more so than ever, particularly around inflation, because I do have, at the risk of sounding as though I've been around too long as a boring old timer, I do have very direct experience, both as a consumer and an investor and as a business journalist, of when inflation was double digits in the early 80s, and the mighty efforts that central banks made, and successfully, along with some other factors that helped them, bring that under control. And if I had to pick one side of the argument on the other, I would still come down on the side that inflation, as we're seeing it now, is transitory. If we just look at today's figures out this morning from Statistics New Zealand, the big drivers there were housing costs and energy. On housing costs, it's very, very hard to see how our housing costs are going to be higher, and in fact a small increase in interest rates will be very helpful to just keep the lid on that. So I don't see those going much higher. And energy, I'm not fooled for a moment by these current high prices for crude oil and gas. There is an amazing abundance of fossil fuel reserves out there in the world, and although those fossil fuel producers have been starting to pull back on investment, there is still plenty of capacity there, and they love nothing more than high prices, in which they jump in and supply more and the prices come down. So that's why I'm relatively relaxed. However, having said that, if high inflation does become baked into people's expectations and expectations, that's when it becomes a good deal more damaging and hard to deal with. That's why I think central banks now have this incredibly difficult balance. So on one hand, they do need to lift interest rates that are obviously historically very low, but they have to make sure that if there is some inflationary expectations, they're nipping those in the bud. But at the same time, they've got to be very careful not to slow down economies too much. Lastly, on economies, we just had last week a revised global outlook from the International Monetary Fund. And though they did downgrade their forecasts last made in October, the world economy, they reckon, is still going to grow above trend this year at 4.4%. And the split there is high income countries like ours growing at 3.9%, and again above trend, and developing countries at 4.8%. Yes, there will be all these disruptions and complications of COVID still, but I would remain very confident about growth holding up well this year. And that, of course, is good for companies in the markets because that's expanding business. So whilst I am very aware of all the dangers, and I'm very alert. I'm not relaxed. I can see what's going on here, and I'm just fascinated to work with these trends, and to see how they play out.
Yeah, awesome. And you've touched there around the role of the central banks and the levers that they've got to pull. Do you want to just dig into a bit more about those? Because I think you've kind of talked about that as being a lever that they've got. Yeah, how does that impact what's coming and either side of that?
Well, if, for example, just going back to the Fed today, the Fed funds rate, as indeed central bank rates around the world, have been astonishingly low for a very long time. And therefore, there is scope for those to rise. And Jerome Powell, the chair of the Fed, was very circumspect, in a sense, in his comments this morning, US time, in terms of it was clear that the Federal Reserve is prepared to act vigorously, but he was refusing to be drawn on the frequency or the severity of that. But say, for example, a percentage point rise in Fed funds looks very likely, but that's still very low, so I think it's going to take a little while for markets to tune in to settle down a bit around this new environment, but which is why the next few months are very crucial. And I think he was right to be non-explicit there about quite what track the Fed's on, because the conditions are changing quite quickly, and he needs to keep options open. So when we see in due course the next monetary policy statement from our Reserve Bank, I think we'll see similar sort of signaling.
Yeah, and actually, maybe if we could just jump in there as well, and certainly go along with Rod's comments. And I think, this was positioned as the biggest central bank meeting or Fed meeting for some time. So a lot of expectation. You've seen the markets yo-yoing around, amazing moves. One moment the Dow's up 500 points, next moment it's sort of it's gone the other way. So I think that there was a little bit of a lack of detail today, and I think that's why there's some uncertainties have been unresolved, as it were. The devil's always in the detail, and so when you say you're going to lift rates soon, that doesn't really say a lot, does it? There was a press conference afterwards, and Mr. Powell didn't rule out aggressive rate rises, but he didn't give any timing. They have these things called dot plots, where all the 12 members of the committee have their own views on where rates should be, and there's quite a difference there. Also, the timing of the reduction of asset purchases, which is another stimulus, QE, that sort of wasn't really talked about in terms of when. So I think the markets have sort of gone away still questioning things a little bit. And I think, part of that is due to, we've seen this unprecedented stimulus. The taps need to be turned off, but not aggressively so, because inflation is there, but there's a bit of a balancing act. We've still got Omicron, as he pointed out. We've still got risks there. And also, the Federal Reserve is well aware of market volatility. They don't ignore the fact that the Dow's yo-yoing around, because market volatility and share market volatility actually has a real-world impact. So, as Rod said, it's very much like a trapeze artist, a bit of a balancing act. Doesn't want to go too far one way or the other. Does have to cool things down, but by the same token, doesn't want to overextend. So I think that was the key thing. I think that's why there was such a reaction, because there wasn't a lot of clues as to precise dates, and it was all, even at the press conferences, right? Well, we're going to be going away and giving more detail on that at a later point. So we didn't get all the answers today, and I think that was a key takeaway, really. So I think and it's probably also as us as investors, it just means that it is a factor to deal with. There is this uncertainty. There are these things that we need to navigate probably in the coming weeks, if not months. But also, as Rod mentioned, just to wrap up on that point, growth is looking good, and I think you're also seeing this come through in the earnings season. We had a big miss from Netflix, but largely it's been positive. Tesla was up today. It's come out for good reports. We had Microsoft, that's a tech, if not an economic bellwether, going along quite nicely. But that growth is moderating a bit as well. So it's positive, but yeah, these are all factors that that we have to deal with as investors.
May I just chip in a couple of thoughts about volatility? And I want to preface them by saying, please don't misunderstand that I'm just being incredibly relaxed about what's going on now. I'm being very alert to what's going on, very mindful. The first thing is that whilst markets are volatile, we have seen far more extreme volatility than this, and volatility that's completely blown apart. I kind of use that phrase almost deliberately, financial systems. So if I, again, at the risk of sounding harking too much back in the past, Monday, the 19th of October, 1987, Black Monday, the 87 stock market crash, I was the Financial Times Wall Street correspondent based in New York, and sitting in front of the Dow Jones telerate screen, as we called it at the time, was completely petrifying, because prices were in free fall, and the Dow Jones Industrial Average lost 25%. Value fell by a quarter in the day. And it's the only time I've ever been in a press conference where I had panicked journalists around me. And I remember one television reporter asking John Phelan, the chairman of the New York Stock Exchange, well, prices are in free fall, they're going to go to zero. And Phelan, who was a wonderfully effective and good chair, very Irish American, said, well, my advice to you would be buy at one. And it was, and of course, it was an astonishingly desperately dangerous week, because financial systems and markets were completely seizing up. And we're not there yet with this. And we are nowhere near yet. Maybe, hopefully we won't get there, what it was like in the early days of the global financial crisis, where again, financial systems and markets were breaking down completely. We do have volatility. You can make a case that we're going to get to those extreme places where value is completely destroyed, or very largely, a large chunk of value is destroyed, and systems can't cope. But I just wanted to, as I say, this is not to be complacent. It's just to try and bring that bit of perspective into where we're at today.
Yeah, I think that's hugely, it's really interesting as a reference point and for context of what's going on right now, because, we have, you talked about 25% in a day. Some analysts are saying that the S&P 500 is heading for a market correction at the moment, which is the drop of more than 10% from its most recent peak. So what is different, or I guess, what can we expect from this and moving towards a market correction?
Well, yeah, happy to jump in there, but obviously, corrections. While some people might not like the word in terms of the stock market, as you say, 10% move from the recent highs, but that is the last high, and you've got to remember that. Not even just last year, but from those pandemic lows, the US markets have gone on a massive run, huge run. So the Nasdaq is already down, already had in that correction mode, but. It is actually healthy. It might seem strange to say that, but markets don't go linear one way in either direction, for an extended period or forever. So you often hear the phrase, markets climb a wall of worry. And you look at any chart over time, and there's always, even if it's moving upwards, which are arguably the US markets have been since the GFC. You've had corrections, obviously along the way. Obviously, we did have that big dip in March 2020. So, I think it's not necessarily. It's a function of how far markets have gone on the upside. So, I think a correction in 2022 was to be expected. Actually, was one of our predictions right at the start of the year, and plenty of others were sort of saying the same sort of thing. I think what surprised investors a little bit has been the veracity of that, and and the short duration of it, I suppose, and the big swings. We, in terms of the Dow swinging 1,000 points, I'm struggling to remember too many times that's happened within the space of an hour. I actually can't think of any, but I'm sure maybe going back further. So I think it's not necessarily, no one likes checking into their portfolio and seeing, their stocks down, 10% on where they were last month. But if you adopt maybe a bigger picture view, it's maybe not something to be feared. And as I say, it's a healthy part. I think, particularly when we've got growth coming through, as Rod's mentioned. We've got central banks which are being, they're withdrawing stimulus, but they're not doing, so rapidly. They're being accommodative still. So there's all those mechanisms there. I think, way we're looking at it and taking sort of a longer view, I think the next sort of few weeks and months are opening up opportunities to get into great quality stocks, which had just run too fast last year, and valuations were just too high in some sectors. So I think it's not a bad time to be opportunistic, but of course depends on your time frame.
And the most important thing, perhaps, in terms of staying calm and focused through this, is never ever focus on how many points, because 1,000 points on a 35,000 Dow is very small in the greater scheme of things. Likewise, don't be obsessed by X number of dollars coming off the price of a share. Always, you have to look at the scale of the movement and the speed of the movement and the volatility and all those things. And so that does help you keep that perspective. So I urge people to at least do that.
So just coming back to the Federal Reserve decision today. So it was the decision was made to not change interest rates right now. That's the outcome. And we've talked a bit about, what else came out of that. But a lot of people were anticipating this announcement, and it was seen as being this big moment. We talked about how often meetings happen, but this one had a real anticipation behind it. Rod, why were people waiting? Why this one? And and what does that mean for us moving forward?
There is a bigger context, of course, beyond just the important one of exactly what they say about interest rates, which is how the Fed is seeing the state of the economy and how it sees its role changing. And for me, a very important part of the announcement today was the very clear confirmation that the Fed is shutting down all the spigots, it's tapering off, and indeed it would hope to start selling off its absolutely eye-wateringly large balance sheet accumulated through all this support, first of all in the global financial crisis, and it never really backed off its balance sheet from that, and then it's kind of escalated enormously during COVID. And so it is a really important turning point, and the actual timing of interest rate change here, I think, is less significant in one sense in the bigger scheme of things, rather than what the Fed is signaling about its view of the world and its intentions. So it was an important meeting, and because the Fed is so influential, obviously, globally, not just in the US. So I think is that bigger picture is important here, not just the precise thing about interest rates.
Yeah, and I think I'd go along with that and certainly say markets are forward-looking, so it's also to do with the outlook. And as Roz mentioned, it's not so much about what they were going to do at this meeting. Most investors are picking them to do nothing. It was more about what they say about going forward. And as I said, that we've been left a little bit for wanting. But it also is an important turning point because obviously rates have been low for so long that while a 25 basis point or a 50 basis point that might not seem like a lot, when you think about it in percentage terms, it is a lot when you've got interest rates so low. So I think it's all about relativity, as Rod was mentioning earlier. So I think that's really important to look at. And it is that pivot. And you look at the Kiwi market. The Kiwi market arguably underperformed, not because we went into lockdown towards August. It was because actually in October, the RBNZ was one of the first to raise rates. That's when our market started to underperform. So I think, that's the key thing, a turning point, and also the forward guidance. And as I said, also that percentage move, and you're also seeing that play out with bond market reactions as well.
Yeah, so let's turn our view now to what this means for people and for our investors. So, because a lot of people tuning in today will be noticing a change in their portfolio, taking on this news, taking on these announcements, but saying, what does this mean for me, and how should I be thinking about this? So, interested, what are some of the things that investors should be considering and keeping in mind when they're looking at their portfolios at the moment?
Well, if I could jump in there, I suppose one thing that we're looking at, I think you've got to be mindful is a rising tide lifts all boats, as they say, and I think going forward, there may be a bit more of a focus on quality. And you're starting to see that. I think even if you look at last year, the IPO market, for instance, good companies did well. Perhaps some of the lower quality ones didn't. And I think you're also seeing that in reaction to some of the earnings announced. So I think we may see that that pivot more by the markets, as it were. Whether we see a rotation away from technology names which have done amazingly well during the pandemic, have been turbocharged towards old economy stocks. I mean, that could also play out. But I think certainly markets going forward, investors maybe should be mindful of this, that it might be a bit more of a focus on quality and also valuation. And look, there's nothing wrong with investing in high valuation stocks, but I think that they need to keep the importance of them delivering is even more so when you're on the bars lifted as such as it relates to valuation. I think we saw that with the Netflix reaction earlier this week. A lot of those growth stocks have been priced to perfection, and if they keep delivering, that's great, and that'll be well received. If they don't, I think you could see more of a spotlight on that. So I think the other thing, obviously still relevant this year is, just aside from the Fed, is maybe that transition towards reopening, but everyone's a epidemiologist these days, but as an opinion. But obviously that'll be a factor, I think, later in the year, maybe a bit more of a rotation from the stay-at-homers to the reopeners. But obviously Omicron sort of muddied the waters a little bit, as it actually has for the Fed. The emergence of the new variant, I think, has probably cast a little bit of a shadow there as well.
Can I come at this from a different perspective? But I will then get on to sort of sectors and stocks. I'm going to start by saying I think the ability now of very small retail investors to be actively involved in the market is completely fabulous. And so I'm a great supporter of the likes of Sharesies. Sorry, there's a bit more to that. But it don't be just an investor who's just sort of trying to pick the stock you think's going to do really fantastically next. That's really hard to do. Pick stocks you're really interested in and you perhaps understand a little bit more, but also be an active owner. And so that's why I'm delighted with Sharesies that you're actually voting proxies, because this is a really important time for equity owners to be very involved in the strategy and prospects of companies, whether they're addressing the climate crisis or other sustainability issues or everything else. This is a fantastic time for active investors in that sense. And although each of us is very small, we can still play our infinitesimally small role in that. But the second thing is that, and here I'll just revert to a personal view again, although I'm a business journalist and have been very involved in markets and all the rest, and I've taken an active role in my investments. I have always used professional advisors because they have access to all sorts of investment strategies I don't. So where I'm actively invested, it's only at a very small proportion of my wealth, because I want to leave that bigger picture of the wealth to people like Greg. Disclosure, I'm not one of your clients, but anyway. So I think that's really important. And so particularly at a time like this, you can not feel desperately anxious that the equities that you've bought yourself and you're actively involved in you obviously care if they decline in value and you're happy when they rise, but you can say to yourself, well, the greater part of my net wealth is being managed longer term in a more sophisticated way. And so yes, to being very active, but as understanding the limits to that. But then when it comes to the question of which sectors and which companies, I think it's also really important to bear in mind, or have right at the front of your mind, is that the global economy and businesses and investment and life is going to change far more in the next decade than it's changed in decades before, because that's the only way that we could respond to the climate crisis and related issues, and to get to an economy and a society that's more compatible with the climate, with Earth systems. So that huge change is coming. And just this week, there's been a fabulous piece of research from McKinsey talking about the $9 trillion US investment that's required every year. So that means that fantastically interesting opportunities are opening up. But it means that those companies that are not on that journey are in serious trouble. So I will pick only one obvious example. I'm not the least bit fooled, as I said, by oil prices or the prospects of oil companies, because the oil and gas companies have been if I'm looking at a global perspective here, and I'm just using the MSCI Global Equities Index and then comparing it with that minus fossil fuels, that's with fossil fuels has underperformed the global market since 2014, and circumstances now are not, might change that fractionally briefly, but there is no long-term future in those companies, and there are interesting choices to make within the sector about some of those companies which are making a bigger, more genuine effort to transition than others. So, for example, there's an argument for BP over Exxon Mobil, for example. But that's where I think this completely fascinating time to be an investor and be thinking about those and they're long-term issues, but the impact on them, this week, this month, this year is going to be very big. And it's well worth beginning to explore those themes if you're not.
That definitely aligns, because we often talk about, and a lot of our investors will recognize this wording, but it's around investing not being a get-rich-quick scheme and really taking that long-term view. And some of these questions that you're posing about the future of certain industries and about certain things are definitely questions that investors should be asking themselves right now. Because these market corrections or these volatile markets are completely normal parts of how markets behave. But really, and I've seen it coming through in the comments about, time in the market and, some of these behaviors we put in place around our investing, taking that long-term view, taking a step back, considering these questions that you've thrown out about the different industries and how they might fare over the coming years. And really keeping that in mind while there's this interesting news or these headlines coming up about what's happening right now. It's also really important. The more important question is how that impacts, what's going on in the future, because that's really why you're investing. So I'm conscious of time, and I think that we've had so many questions come in, so I might skip to the Q&A now. So the first one, and we'll just do a bit of a free-for-all jump in if you've got the answer to it, but the first one is, would you consider now to be the best time to buy more company shares since the share prices have dipped? Would you expect them to dip further? I think we'll see that. We'll go with that one.
Yeah, look, I think I think there is a reason to buy the dip. Particularly we've talked about our positivity around global growth, around corporate earnings, and so on. Look, everyone would love to buy at the bottom of the dip, and then happy days. You look at it again next week and you're well up. So that doesn't happen in reality, and completely agree with some of the comments coming through about timing the market and so on. So, but broadly, I think it is a good time to be looking at high quality companies that are cheaper than they were last year and last week. And I think it is a good time to be doing that, mindful of course of your own situation and diversified portfolio diversification, should I say, and all that. But I think it is in principle a good time to be looking at it. Not to say that this is the end of the volatility. As I mentioned earlier, the Fed is relevant, even if you don't quite understand some of the jargon that we've talked about today, and that's perfectly okay. This could be a factor, for the markets and investors in the coming weeks, if not months. So there may be more dips and more volatility, but I think in principle, it's a good time to be looking at quality companies and buying the dip, as it were.
Given the nature of Sharesies, where people are focused on individual stocks, I think you might find a case where there is a company that you feel you understand well, and all the advice that you're reading suggests that it's has good prospects, that plays to current circumstances and how those change, and maybe slightly undervalued now. Maybe you want to buy. I've always been a lot more cautious about buying dips. I've sat out some, and obviously over many years now I've regretted that because markets have kept moving up. But this time I just it's for me it's a bit too easy a mantra. Buy the dips, because I think there's some big things at work here, which means that life might not be quite that automatic and as simple as it has been in the market over now quite a long period. And that comes back to that sense of how amazingly overvalued. Again, it depends how you're valuing them, but but essentially how very, very fully valued, if not overvalued, many stocks are. So that's why I'm cautious about buying the dips.
So that kind of covers a few of the questions that have come up in both of your answers. But a quick one from Jack. Would you expect the market to be on a downward trend for the next 6 months minimum?
I wouldn't expect that. I wouldn't expect that. And I'd agree. Probably, there's more challenges and there's more issues to contend with. And I see a few comments there about waiting for the March Fed meeting, and I think I talked about that right at the start. So sort of go along with that. Yeah, there could be more volatility. There could be more weakness in the months ahead. Are we going to be go into a downtrend? I don't think so. I don't think we're going to see that over the next 6 months. But there's two sides to every argument, as you're saying. That's why Rod had a slightly different view to me. So, and that's what makes the market. If you had all buyers, that wouldn't work. So you have to have buyers and sellers. So I think we're not expecting a downtrend for the next 6 months. What I would say, though, is that valuations are extended in certain sectors or certain groups of companies, as we like to call them. So I think there is some caution warranted there, and there's some stocks that are looking cheaper than others. So, but I wouldn't expect a downtrend for the next 6 months.
First of all, I have no idea where the markets are going to be 6 months from now. I want to make that very clear, but also make it very clear that if the markets are on a substantial downturn for 6 months, we're in very different territory here, where confidence expectations would be quite rattled, and so I'm hoping that's not going to happen. Mind you, a more benign version of that is that markets go sideways for a long time. Well, they don't like doing that either. There's money to be made on the upside and the downside, and that's why markets swing around. So I'm not going to make a prediction, I'm afraid. One word. I don't apologize for not making a prediction one way or the other, other than to say, let's hope that there's a collective confidence and wisdom it outbalances those who are driving things in a pretty negative direction.
So now we've got one from Suzanne. We've talked a lot about individual companies and investing, but can we talk about how anything we've talked about has impacted ETFs or funds, and that's exchange traded funds? For any jargon, what acronym busting. So how is anything we've talked about different when it comes to funds?
Well, it's not different per se in terms of the market relationship. I think everything we've talked about today holds true for that. But obviously, if you're investing in a company, there's specific risks that go along with that. If you're investing in a fund or an ETF, obviously that's a diversified basket of companies, or it doesn't actually have to be companies. There's ETFs which extend beyond that. So I think it's similar, but you're looking at more balance with a with an ETF in theory. But then again, you can get into an ETF or a fund which is purely focused on one particular sector, where arguably your risk is increased than if you have a sort of a balance of stocks in your portfolio across a number of sectors. So I think yeah, everything we've said today sort of holds true, because if a broad, say, market fund, an S&P related fund, if the S&P is going down, then that fund will likely go down as well. So I think everything we've talked about today holds true with respect to funds and ETFs.
Yes, I think the only comment I'd add is that, particularly because of the explosive growth of ETFs over recent years, there's a wonderful array of them, with all sorts of different focuses. So I think it's really important to understand quite what an ETF that catches your eye is focused on and how its performance has been going. There's been in the tech space, it's probably a bit unfair to name some individual ETFs that have gone very badly recently, but there have been some, just because of the nature of the investments that lying within that ETF. So I guess my basic message is that don't necessarily, so again, it depends on the ETF. If it's an extremely broad-based one, you're not so exposed to this, but some ETFs are actually surprisingly narrowly focused, and I think you just need to have a good understanding of what sort of ETF you're buying into.
Yeah, look, I think that's absolutely right. There is a narrower focus, but what that also does allow is you to, if you want to get into a particular sector or a particular group of companies, or you're an ethical investor, we at Devon run a sustainability fund. So if you want to go into something like that, you can tailor it. If you decide you're bullish on gold, but you want to have an array of gold companies, you can go into a gold ETF. You can go into a silver ETF. You can go into a healthcare ETF. So I think that's one thing that's great. You effectively buying one security, but underlying that you've got 15, 20, 30 plus investments. So you're achieving diversification, but you're not in a way because obviously you're in one segment of the market. So I think it's great for tailoring investors' choices.
Yes to all that, but again, I just come back to, in a given sector, there's good ETFs and bad ETFs, and you still got decisions to make.
Yeah.
Excellent. So just conscious of time, we're going to have to wrap up now, but I think most of the questions were answered in some way through our discussion, and also, in things that got right in other questions that were asked. But for any other, we will look through and try to provide answers to these as we go. This isn't the only thing we're doing. This is a big part of the conversation moving forward. So first off, I just want to thank our special guests, Rod and Greg, for joining us and for sharing your insight and expertise on the current situation. And then a huge thanks for everyone tuning in and being part of the conversation of what's going on right now, and taking an interest in answering these questions. I hope that you take something away from today. And we also do have other content that dives into this with more detail too. So keep an eye out for our recap podcast, which comes out every weekday, and as well our blog. We are posting things on there. So you'll be able to watch a replay of the discussion right here on Crowdcast immediately after we sign off. And there will also be YouTube and podcast versions available later today. But for now, enjoy the rest of your week and stay safe, everyone. Thank you.